Hello, this is Chapter 19, International Finance and the Foreign Exchange Market. Foreign Exchange Market. Market where different currencies are traded one for another. The exchange rate enables people in one country to translate the prices of foreign goods into units of their own currency. An appreciation of a nation's currency will make foreign goods cheaper. A depreciation of a nation's currency will make foreign goods more expensive. Determinants of the exchange rate. Under a flexible rate system, the exchange rate is determined by supply and demand. The dollar demand for foreign exchange originates from U.S. purchases of foreign goods, services, and assets, real and financial. The supply of foreign exchange originates from sales of goods, services, and assets from Americans to foreigners. The foreign exchange market brings the quantity demanded and quantity supplied into balance. Also brings the purchases of Americans from foreigners into equality with the sales of Americans to foreigners. Foreign exchange market equilibrium. The dollar price of the English pound is measured on the vertical axis, which we have here. The horizontal axis indicates the flow of pounds in exchange for dollars. The demand and supply of pounds are in equilibrium, and the exchange rate of $1.50 equals 1 English pound. At this price, quantity demanded equals quantity supplied. A higher price of pounds, like $1.80 equals 1 pound, leads to an excess supply of pounds, causing the dollar price of the pound to fall or depreciate. A lower price of pounds, like $1.20 equals 1 pound, leads to an excess demand of pounds, causing the dollar price of the pound to rise or appreciate. Why do exchange rates change? Factors that cause a currency to depreciate. A rapid growth of income relative just to the trading partners that stimulates imports relative to exports. A higher rate of inflation than one's trading partners. A reduction in domestic real estate rates relative to rates abroad, and a reduction in the attractiveness of the domestic investment environment that leads to an outflow of capital. Foreign exchange market equilibrium. Other things constant, if incomes increase in the United States, U.S. imports of foreign goods and services will grow. The increase in imports will increase the demand for pounds in the foreign exchange market, causing the dollar price of the pound to increase from $1.50 to $1.80 in this example that we have here. Inflation with flexible exchange rates. If prices were stable in England while the price level in the United States increased by 50%, the U.S. demand for British goods and pounds would increase as U.S. exports to Britain would be relatively more expensive. They would decline and thereby cause the supply of pounds to fall. These forces would cause the dollar to depreciate relative to the pound. Changes in the exchange rate. Factors that cause a currency to appreciate. A slower growth rate relative to one's trading partners, a lower inflation rate than one's trading partners, an increase in domestic real interest rates relative to rates abroad, and an improvement in the attractiveness of the domestic investment environment that leads to an inflow of capital. We have some questions for thought here. Number one, other things constant, which of the following would cause the U.S. dollar to depreciate? A, less rapid growth of income than our trading partners. B, a lower rate of inflation than our trading partners. C, an outflow of capital because of fear that the U.S. stock market will perform poorly in the future. D, an increase in the quantity of drilling equipment purchased in the United States by Pemex, the Mexican oil company, as a result of a Mexican oil discovery. E, an increase in the U.S. purchase of crude oil from Mexico as a result of the development of Mexican oil fields. F, higher real interest rates in Europe, inducing many Americans to move their financial investments abroad. G, an economic boom in Mexico, inducing Mexicans to buy more U.S.-made automobiles, trucks, electric appliances, and personal computers. Number 2, a euro could be purchased for $1.14 in March of 2016, but it took only $1.04 to purchase a euro in December of 2016. This indicates that the dollar appreciated relative to the euro during this period. Is this statement true? Number 3, under a flexible exchange rate system, the equilibrium exchange rate will tend to bring the purchases of our goods, services, and assets from foreigners into balance with our sales of goods, services, and assets to foreigners. Is this statement true? International finance and alternative exchange rate regimes. 3 major types of exchange rate regimes. There are 3 major types of exchange rate regimes. We have flexible rates, fixed rate, unified currency, and pegged exchange rates. We have discussed flexible exchange rate regimes extensively. We will now explain the nature and operation of the other 2 major regimes. Fixed rate, unified currency regime. A system where currencies are linked to each other at a fixed rate. A single central bank conducts the monetary policy that influences the value of the unified currency relative to other world currencies. The linkage may be either through the use of the same currency or through a currency board that agrees to trade the currencies one for another at a fixed rate. Some examples of fixed rate unified currency systems: the United States, Panama, Ecuador, El Salvador, and Hong Kong, all of which use currencies that are unified with the US dollar. The 19 countries of the European Monetary Union all use the euro, which is managed by the European Central Bank. Several other countries, including Bulgaria and Bosnia and Herzegovina, use a currency board to link their domestic currencies to the euro. Thus, the euro is a unified currency in all of these countries. Countries such as El Salvador and Hong Kong that link their currency to the dollar at a fixed rate are no longer in a position to conduct monetary policy. They merely accept the monetary policy of the Federal Reserve. The same can be said for the 19 countries of the European Monetary Union and the other countries that link their currency to the euro, all of whom accept the monetary policy of the European Central Bank. Pegged exchange rate regimes. Pegged exchange rate system, a system where the country commits to using monetary and fiscal policy to maintain the exchange rate value of the domestic currency at a fixed rate or within a narrow band relative to another country or bundle of countries. Unlike the case of a currency board, however, countries with a pegged exchange rate continue to conduct monetary policy. When pegged regimes lead to problems, a nation can either follow an independent monetary policy allowing its exchange rate to fluctuate, or tie its monetary policy to the maintenance of the fixed exchange rate. It cannot, however, maintain currency convertibility at a fixed exchange rate while following a monetary policy more expansionary than that of the country to which its currency is tied. Attempts to peg rates and follow a monetary policy that is too expansionary have led to several financial crises, a situation where falling foreign reserves eventually forced the country to forego the pegged rate. The experiences of Mexico in 1989 to 1994 and of Brazil, Thailand, South Korea, Indonesia, and Malaysia in 1997 to 1998 illustrate this point very clearly. Here's some questions for thought. Can a nation fix its exchange rate to another currency such as the dollar and at the same time follow an independent monetary policy? Why or why not? Number 2, if a country operates under a currency board regime, the country commits itself to A, an expansionary monetary policy in order to maintain the convertibility of its currency, B, issuing its currency at a fixed rate in exchange for an equivalent amount of another designated currency, and investing the funds in bonds and liquid assets which provide 100% backing for the currency units issued. C, raising taxes in order to maintain the convertibility of its currency. Balance of payments. Balance of payments are accounts that summarize the transaction of a country's citizens, businesses, and governments with foreigners. Any transaction that creates a demand for foreign currency and a supply of the domestic currency in the foreign exchange markets is recorded as a debit item. Example, imports. Transactions that create a supply of foreign currency and demand for the domestic currency on the foreign exchange market are recorded as a credit item. Example, exports. Under a pure flexible rate system, the foreign exchange market will bring the quantity demanded and the quantity supplied into balance, and as a result, it will also bring the total debits into balance with the total credits. Current account transactions, all payments and gifts related to the purchase or sale of goods and services and income flows during the current period. 4 categories of current account transactions: merchandise trade, service trade, income from investments, and unilateral transfers. Capital account transactions is a transaction that involves changes in the ownership of real and financial assets. The capital account includes both direct investments by foreigners in the United States and by Americans abroad, and loans to and from foreigners. Under a pure flexible rate system, official reserve transactions are zero. Therefore, a current account deficit implies a capital account surplus, and a current account surplus implies a capital account deficit. Exchange rates, current account balance, and capital inflow. As these figures for the United States indicate, under a flexible exchange rate system, the inflow and outflow of capital exert a major impact on current account balances. Are trade deficits good or bad? With flexible exchange rates, an inflow of capital implies a trade deficit. If a nation's investment environment is attractive, it is likely to result in a net inflow of capital and trade deficit. When this inflow of capital is channeled into productive investments, this is a positive development. However, if the inflow of capital is used to finance current consumption or for the finance of unproductive products, it will exert an adverse impact on future income. In recent years, a substantial share of the United States trade deficits have arisen from this source. Should trade between countries balance? Political leaders often imply that U.S. exports to a country, China or Japan for an example, should be approximately equal to our imports from that country. This is a fallacious view. Under a flexible exchange rate system, overall purchases from foreigners will balance with overall sales to foreigners, but there is no reason why bilateral trade between any two countries will balance. Rather than balance, economics indicates that a country will tend to experience trade surpluses with trading partners that buy a lot of goods that it supplies at a low cost, and trade deficits with trading partners that are economical suppliers of goods that can be produced domestically only at a high cost. Questions for thought. Since the early 1980s, the United States has persistently run A, current account deficit and a capital account surplus. B, both a current account and capital account deficit. Number 2, under a pure flexible exchange rate system, a nation that has a current account deficit will also have a capital account surplus. Is this statement true? Explain. Number 3, countries that offer attractive investment opportunities relative to those available elsewhere will often experience an inflow of capital and a trade deficit. Is this statement true? A, no. If a country's investment environment is attractive, this will generally lead to an outflow of capital. B, no. If the investment environment of a country is attractive, it will generally run a trade surplus. C, yes, the statement is true. Number 4, if other countries did not impose trade barriers that limit our exports, the flexible exchange rate system in the United States would bring U.S. exports to a specific country, Japan, for example, into balance with U.S. imports from that country. Is this statement true? And number 5, will a healthy economy run a balance of trade surplus? Is a balance of trade deficit bad? 6, in recent years, U.S. imports from China have been substantially greater than U.S. exports to China. This bilateral trade deficit is A, proof that the Chinese treat US produced goods unfairly, B, surprising because the flexible exchange rates of the United States should bring its bilateral trade with another country into balance, C, not surprising because there is no reason why bilateral trade between two countries should be in balance. 7. In recent years, the U.S. has run trade deficits with Japan, China, and Mexico. Does this indicate that these countries treat U.S. producers unfairly? Why or why not? And then number 8. In recent years, the United States has run trade surpluses with the United Kingdom, Belgium, Brazil, and Australia. Does this indicate that the U.S. treats the producers of these countries unfairly? Why or why not? This is the end of Chapter 19. Thank you for listening.